Hello, everyone. Thank you for joining us today. So while TIF is a subject that can get complicated and detailed, this presentation attempts to provide a thorough but accessible overview to introduce the key concepts, context, and attributes of tax increment financing in Minnesota. It is also meant to be a valuable refresher for those that have kind of intermittent experience with it and might appreciate the recontextualization. Um, and an additional webinar on TIF administration for authority staff will be held this Thursday, July 25th. So if you haven't signed up for that and you're interested, do so. That will also be released as a video shortly thereafter if you aren't able to join live on Thursday. And we had a webinar for county staff last summer, and that video is still available on our website for those of you who work in counties and might be interested in that. There's going to be a survey after you leave the session at the end, so we'd very much appreciate it if you'd share your feedback with us. It'll also be emailed if you don't have time immediately at the end of this. So, all right, well, so let's begin with the basic question. What is TIF? TIF is different things to different people. It's a public financing tool for businesses and economic development professionals looking to initiate development projects. It's a revenue type or fund to finance directors and accountants who handle the financing activities. It's a feature of the property tax system for county auditors and affected taxing entities. And for all involved, including us as oversight administrators, it's a statutory program. And perhaps that's the key takeaway, to just not be limited by your narrower perspective or duties, but to understand that there are laws and limitations and compliance components that need to be understood. This is especially true for TIF authorities making use of TIF, and someone from each TIF authority should make sure to have their eyes on the bigger picture. So hopefully this training can help you raise awareness of that bigger picture. Okay, I'll start here with a very brief illustration of the TIF concept as a reminder of what TIF is and how it affects property taxes. So normally when new value is created by private development, it immediately becomes part of the tax base and produces a share of tax levies. When tax increment financing or TIF is used, the new value created during the life of a TIF district is captured and does not become part of the tax base until after the TIF district ends. And so while the TIF is active, only the original value is part of the tax base, and the taxes on the new value, the tax increments, are used to pay debt instruments that finance the costs that enable that development to occur. This capture of value might seem like a negative that hurts the tax base, and it is if the development does not need TIF. However, if the new value would not happen but for the use of TIF, and TIF is truly enabled by that, if TIF truly enables that new value to occur, then this capture of value and taxes is considered a neutral necessity that produces the greater tax base when the TIF district ends. So local governments using TIF must make such a but-for finding in order to be able to use TIF. To provide a definition, therefore, we can say that tax increment financing, or TIF, is a financing tool where the new value from a development is captured from the tax base so that the property taxes on the new captured value, i.e. the tax increments, can instead pay qualifying costs that enable the development to occur. So quite simply, as the illustration here shows, the new value created over the life of the district, again, is not part of the tax base until after the TIF district ends. And while it's active, it's just generating the increments that help finance the development. And as we go along here, we're going to come back to this definition and talk in more detail about each of its parts. First, though, let's look at who uses TIF. The municipal bodies that use TIF are referred to as TIF authorities. In 2022, there were 380 authorities that filed reports for 1,669 districts. There's also 4 more authorities that failed to report for 4 districts, and so they're being subject to have their increment withheld until they complete their reporting. TIF authorities include nearly all cities over 5,000 and a large number of small cities. TIF was used by 10 county entities, and this map only shows the individual county entities, but there's also a couple of multi-county entities as well. So 61% of districts created by these authorities are actually located outside the metro area, but 79% of tax increment is generated in the metro, where values are higher and larger projects are more common. The term TIF authority derives from the fact that municipal bodies get their authority to use TIF and to undertake various development projects from various development acts. The most common TIF authorities are cities and city entities like port authorities, economic development authorities, housing and redevelopment authorities. County and multi-county HRAs or rural development finance authorities, and one large metro township can also be TIF authorities. The development acts listed for each of these governs how the projects can be undertaken. The TIF Act doesn't authorize projects and the use of TIF. It regulates how TIF works and how it can and cannot be used. So it's important for TIF authorities to be well versed in the laws authorizing and governing the use of TIF. So there's different sets of statutes to be aware of. And unless there's some specific authority for a local government entity to be using TIF and to undertaking development that generates TIF, those entities cannot be TIF authorities. So logistically, development acts govern project areas in which broader development activities occur beyond just the TIF-supported developments. Sometimes, and actually quite often, they're coterminous with the city boundaries. TIF is used more narrowly by creating TIF districts that consist of the parcels on which the finance development will occur. There can be many TIF districts within a single project area. Districts are where the increment is generated and where most of the increment must be spent. But understand that some increment can be spent outside the TIF district, but within the larger project area. And we'll talk about that more momentarily. You might notice that authorities commonly name districts in a manner like TIF 1-3 or TIF 2-1. Generally, that first number is referring to the project area, and the second is referring to the district in the project area. So TIF 1-3, for example, might be the third TIF district in project area number 1. And they're not all numbered like that, but it is very common to see that. The relationship between project areas and TIF districts raises an extremely important concept called pooling. When tax increment is spent outside of the district and in the project area, it's called pooling, and that's not a statutory term. It's just a term in common usage. The idea being that funds from multiple districts could be pooled to fund project costs, although we call it pooling even if there's only one district. Just think of pooling as meaning out-district spending. There's an overall pooling limit of 25% for redevelopment districts and 20% for all other district types, but there's also an option that authorities can elect to pool an extra 10% if it's used for certain affordable housing purposes. There's two provisions that sought to focus TIF usage and promote early decertification, and they're referred to as the 5-year rule and 6-year rule. The 5-year rule defines costs that are obligated after the first 5 years as being out-district costs that would have to fit within the pooling limit. I'll get to the rationale later, but it's important to understand that expenditures inside the district are only considered in-district costs if they're spent or obligated for activity occurring in the first 5 years. The 6-year rule requires generally that districts be decertified when there's sufficient increment to pay in-district costs and obligations. And that rule drives a lot of early decertifications. And there were big changes made to this rule in 2023 that our office had proposed. There are 5 statutory types of TIF districts in Minnesota, each with their own requirements and limitations. Redevelopment, housing, and economic development districts make up 97% of all districts. There's also renewal and renovation districts and soil condition districts. Some laws over the years have created districts for limited situations. For example, there are housing transition districts that are authorized for 4 cities and a distressed rental property district authorized for 1 city. Those narrow laws are uncodified and they're not included in TIF statute. And there's also one type of subdistrict, a hazardous substance subdistrict, that can be created within one of the normal district types to capture additional increments when the remediation of hazardous substances is necessary and has been encountered. As you can see here, redevelopment districts and housing districts can each collect increment for 26 years. Economic development districts are limited to 9 years, given that they have a more debated policy justification. And renewal and renovation districts are limited to 16. Soils condition districts can collect increment for 21 years. Redevelopment and renewal and renovation districts are similar to each other in that each requires meeting a blight test, where the authority must find that certain conditions exist. For redevelopment districts, parcels consisting of 70% of the area of the district have to be occupied by buildings, streets, utilities, paved or gravel parking lots, or other similar structures. And more than 50% of the buildings, not including outbuildings, must be structurally substandard to a degree requiring substantial renovation and clearance. Alternatively, certain rail properties, tank facilities, and qualifying disaster areas can also qualify as redevelopment districts. For renewal and renovation districts, the same 70% coverage test must be met, but only 20% of the buildings need to be structurally substandard, while another 30% of the buildings must require substantial renovation or clearance to remove existing undesirable land use conditions, like incompatible uses or overcrowding or other hazards. So for both of these district types, 90% of the increment must be used to finance the costs of correcting such blight conditions. Economic development districts must be found to be in the public interest because they discourage commerce, industry, or manufacturing from moving operations to another state or municipality. They increase the employment in the state, preserve and enhance the tax base of the state, or they satisfy the requirements for a workforce housing project. These districts are limited, however, to certain uses. No more than 15% of the square footage of buildings and facilities can be used for purposes other than the list here: manufacturing, warehousing, storage and distribution, research and development, telemarketing as the exclusive use, tourism facilities, which have certain qualifications, space used for and related to these uses, or for workforce housing projects, which again have their own certain qualifications that must be met. So generally speaking, economic development districts are not meant for commercial and retail development. Those activities are generally should depend on the existence of a suitable local market, and they're not as footloose as the qualifying uses. But there is an exception for small cities. So those cities that are 5,000 in population or less and located 5 or 10 miles or more as the crow flies from a city of 10,000 or more. The requirement had long been 10 plus miles, but was just recently changed last year to be a 5+ mile parameter for new districts going forward. These small cities may assist a commercial retail facility up to 15,000 square feet, but increment can only be used to assist that facility and to pay admin costs and cannot be used for pooling for other purposes. Housing districts are for low and moderate income housing projects as defined in federal, state, or municipal law and are aimed at increasing the supply of affordable housing. Tax increment from these districts may solely finance the cost of housing projects or pay related administrative and public improvement costs. And because such housing developments are generally considered in district, even if they're located outside the district, pooling limits are generally not applicable to a housing district. That's the only district type where you don't really have to worry about pooling. And a small portion of buildings can be for non-residential uses, like street level shops, maybe in a multi-story housing complex, but that's limited to 20% of the square footage of buildings. There's income limits that apply to qualifying projects. For an owner-occupied housing project, the initial purchaser and occupant must meet the requirements for a qualified mortgage bond project as defined in Internal Revenue Code. And generally, those projects require the income to be less than or equal to 115% of the area or state median income. For rental housing projects, properties must meet the requirements for a qualified residential rental project, again under the Internal Revenue Code. And these projects generally can meet one of two different tests, where either 20% of the units are occupied by those with incomes that are less than or equal to 50% of the area median income, or 40% of the units are at 60% of the area median income. And the MHFA challenge program limits can also substitute for those projects. Soils condition districts can be used when an authority finds hazardous substances, pollution, or contaminants that require removal and remediation, and where the estimated cost to correct is greater than $2 per square foot. A redevelopment action response plan has to be approved by the Minnesota Pollution Control Agency, and the tax increment may only be used to pay for acquisition costs and removal and remediation costs and administrative costs. Hazardous substance subdistricts are generally used within one of the other types of districts when pollution and its additional costs are encountered. And it's for parcels that are designated as hazardous substance sites, along with potentially contiguous parcels. The authority must find that development or redevelopment would not occur through private investment or other increment, that any contiguous non-designated parcels are expected to be developed along with the designated hazardous substance sites, and that the subdistrict is not larger than or won't collect increment longer than is necessary to cover the additional costs caused by these sites. So these subdistricts also require PCA approval for development action response plans, and the subdistricts create additional increment by reducing the original value, generally down to zero. And then that additional increment may be only used to pay for removal and remediation costs, pollution testing, demolition and soil correction, insurance and liability protections, and administrative and legal costs, including any costs of the PCA or the Attorney General, which might get involved to help hold the polluter accountable. Okay, before we get back into the components of our definition, do we have any questions that have come up so far?
Hey, I haven't seen any questions so far. And unfortunately, my apologies, Jason, but the polling feature seems to have just disappeared off the face of the earth, so we won't be able to. We had set up some quizzes. Yeah, we had set up some quizzes for you all to take, and we practiced it yesterday, and I saw that they were there this morning, but they're just gone.
Oh boy. Okay, well, we can, instead of actively answering in the chat, then we can just introduce the questions here, and you can think about it, and then I'll give the answer. So our first question was going to be, the income limits for housing districts apply only to the initial occupant for A, owner-occupied housing, B, rental housing, C, both, or D, neither. And the correct answer to that is A. The income limits only apply to the initial occupants for owner-occupied housing districts only. For rental housing projects, it's an ongoing requirement that the tenants be meeting those income limits. So make sure that when you're doing a housing district, between you and the developer, there's active ongoing monitoring of the income limit compliance in order for the district to continue to qualify for TIF assistance. So, all right, well, let's continue then by returning to our definition of TIF to take a look at its various components. We've first noted that TIF is a financing tool. So it's worth noting that TIF is not an incentive that's a tax break or a tax reduction or a tax abatement. The taxpayers in a TIF district do pay their full property tax on the parcels, even on the captured value. It's just that the incremental taxes on that captured value become a revenue stream that the TIF authority uses to finance the costs that assist or enable the development. So because development costs are generally incurred up front, while tax increments are collected over the duration of the district, debt obligations are needed and become an important consideration. The most common type of TIF debt obligation, representing 70% of all the TIF debt reported for 2022, is a pay-as-you-go or pay-go note, where the authority has an agreement to reimburse the developer, owner, or note holder for the qualifying costs that the developer or owner incurred and separately financed. These have become more popular over time, which you can see here on the right, where even in the last 10 years, the popularity of these has grown. And this is because the risk is not borne by the TIF authority should actual increments end up falling short of projections and becoming insufficient to pay all the costs. With general obligation or GO bonds, they still are used quite regularly, but they were far more common in the early years of tax increment financing. And with bonds, the municipality pledges its full faith and credit and must raise taxes to pay the bonds if tax increments are not sufficient. Revenue bonds, which pledge only tax increment revenues and not full faith and credit, and other, or it may pledge other revenues like special assessments. Those are less commonly used because I think they're generally less attractive to investors who end up bearing more risk. Many districts also make use of interfund loans where internal dollars are borrowed from one fund of the municipality. And usually that's done to cover supplemental costs, like administrative costs are often financed through an interfund loan. It's not generally the full funding, sole funding source of a district, although that has, we have seen that at least a few times. Next, let's take a look at the second part of the definition, this notion of capturing the new value. Let's look at an example here where a vacant, deteriorated, and structurally substandard property before development has a market value of $200,000. And the proposed development would be valued at $3.4 million after development. When a TIF district is created, the authority must request that the county auditor certify the original value of the district for the base year. So any new value in subsequent years, measured as the current value minus that original value, will be identified as the captured value. So with our example, here we see market values on the left and equivalent net tax capacities, or net NTCs, on the right. NTCs being the values that are used in property tax calculations. And so as a quick aside here, the terminology of net tax capacities may be familiar to most, but not all of you. And if you're new to Minnesota's property tax terminology, it might strike you as a confusing term, and you might wonder why these amounts seem oddly small compared to the market values. It's named this way because in 1988, the legislature decided to define values to be in similar proportion to desired effective tax amounts, and thus the name comes from the desired net tax capacity. The thinking was that high and low tax rate areas could be judged by how close the tax rate was to 100%. And that concept never really worked out like they envisioned. But nevertheless, we have this odd terminology now for what most states might just call assessed value or taxable value. We're calling it net tax capacity. And we have values that are expressed as small amounts and rates that are expressed in large percentages as a result of this. But anyway, getting back on point, for this example, the TIF district is comprised of a parcel that has a base year market value of $200,000 or $3,250 in net tax capacity. And then after development, the current market value is $3.4 million or $67,250 of net tax capacity. So $3.2 million would be the captured market value, and there's $64,000 of captured net tax capacity. Captured value is not part of the tax base, meaning it's not used to calculate the tax rate or to generate any of the local levies, by the county, city, school district. The tax rate is still applied, though, to the captured value, and that's what yields the tax increments that get used to finance development costs. So before continuing, I'll do one more quick aside here for those of you that might be tuning in to kind of learn about TIF as a feature of the property tax system. When we talk about capturing tax base, it should be noted that there are different types of property tax bases. And to describe this very briefly, property taxes are generally the result of a value times a rate. And the value starts with the assessor's determination of estimated market value. However, there's the existence of different exemptions and exclusions and value deferrals. That means that not all of a property's value is being taxed at its full market value. So the taxable market value becomes for most taxes. It's determined by multiplying that taxable market value times that class rate based on the type of property, like commercial or homestead. And these percentages are small, and that's why the values are more comparable to tax amounts in terms of order of magnitude. So some property taxes, however, though, use a different tax base called a referendum market value. Referendum market values typically equal the taxable market value or some portion of it for select classes of property. So like, for example, farmland is not subject to RMV levies. There's one more wrinkle. The state property tax is levied on net tax capacity, but only for certain property types. So tax systems distinguish between local net tax capacities and the state net tax capacity as two separate tax bases. So you end up having three different tax bases here. But it's important to know that TIF only captures value for local net tax capacity tax-based levies. TIF does not capture state net tax capacity or otherwise affect the state property tax levy, and it does not capture or otherwise affect the local referendum market value based levies.
Hey, Jason, before you move on here, we did get a question in the chat that goes back to TIF as a financing tool. Okay. And they're asking, you say that TIF is a financing tool, but when pay-as-you-go is added, doesn't it become a tax break?
Not necessarily. I mean, kind of, in that the TIF districts are helping to finance the activity, but strictly speaking, that property owner is paying their full tax amount, right? So you're not trying to incentivize activity by giving people a reduction in taxes. You are charging them their full taxes, but when in a pay-go arrangement, you're then returning the taxes that they pay to them to reimburse them for the costs that they've incurred. So, you know, if so it is in that way, it can feel very much like a tax break, but technically they're paying that full tax and they're just being reimbursed for some of the costs that they incurred. So, so that's where there's a bit of a distinction. But yeah, it is. You can argue that it's more akin to a break in those kind of situations. But sometimes too, the developer isn't the current property owner. So like, you know, think of an owner who develops a strip mall or something. Each of those individual tenants are paying their full property taxes. They're not getting any kind of break. It was the developer who's getting financed, you know, reimbursed for the costs that they incurred. So it is a little bit different than just a pure tax break. It's more of a financing mechanism. So good question though. Okay, so we come back to our definition here, and let's take a look at the part of our definition where we say that property taxes on captured value are segregated as tax increments. We've said that the tax rate is applied to the captured value, creating additional taxes above the local levy amounts. So to illustrate using our example, the tax base that will help support local net tax capacity levies will basically remain just that original value of $3,250 in net tax capacity for the full duration of the district. So from the perspective of taxing entities looking at their tax base that can support their local levies, it's really as if the development hadn't even happened. But by applying the city, county, school district, and special tax tax rates to the district's base value, that $3,250, let's say those rates may raise local levies of $4,448 in total, with monies going to each of those jurisdictions. Now, that rate is still applied to the captured value, and when that's done, the total tax on the captured value in this example equals $87,594. So this revenue is what is separately identified as tax increment revenue, and it's distributed by the county auditor to the TIF authority, who then has to segregate those funds and follow all the laws and restrictions on the use of tax increments in order to finance development costs. The implications on the tax base, rates, and levies should be well understood. Capturing value from the tax base directly affects rate calculations. Tax rates are determined by dividing a jurisdiction's adopted property tax levy by the value of its tax base, which excludes the TIF district's captured value. So for example, let's assume the city had a total net tax capacity of $1,064,000, and the TIF district is capturing $64,000 in net tax capacity, leaving a total city tax base of $1 million. So let's assume that the city said we need, a property tax levy of $467,700 to fund our city. So the city tax rate would be 46.770% when calculated using the tax base that excludes the captured value. If the TIF district were terminated, though, or if it weren't needed, and that $64,000 of captured value became available to support that same levy, then the tax rate would be only 43.957%. Understand that the tax increments are additional taxes. So when you apply the tax rate to the uncaptured value, you're going to raise your full levy amount. But applying it to the captured value generates those additional taxes. Here, the city levies generating almost an additional $30,000 above the levy amount that was adopted by the city. And so this almost $30,000 here is the city's share of the full $87,594 that we saw on the last slide, because the county tax rate and the school tax rate and the special district rates are providing the rest of that total tax increment. The capture of tax base may also be indirectly impacting judgments about how much to levy given sensitivity to higher tax rates. In this example, if the TIF district terminated or decertified, the city could raise the levy amount and keep the same tax rate and enjoy additional revenues, or it could keep the levy the same and let taxpayers enjoy eased tax burdens, or something in between. So you can see how creating new tax base has very positive implications if that tax base wouldn't have existed without the assistance of TIF, because then TIF can help lower tax rates or enable more revenues when the district ends. But capturing tax base that would have existed anyway without TIF has the opposite implication of raising rates and taxes and putting more pressure on levy decisions for the full duration of the district. And so a model of the TIF concept will also help illustrate this idea. The general premise from its redevelopment origins is that property might be blighted, meaning the value is declining or stagnating, and that's expected to continue absent any public intervention or assistance. So when a TIF district is created, that original value at that point in time is established or frozen as the tax base for the duration of the district. And when the public financing at TIF, with that financing in place, development is enabled, and now the value increases as a result. And again, the tax rate is still applied to the captured value, but those taxes are segregated as tax increments and are not part of the levy. So when the TIF district ends, that's when taxpayers realize the public benefits of the whole endeavor as new tax base is available to support local levies. And the captured value that provided the tax increment is generally viewed neutrally as the investment that made the benefits possible, rather than negatively as some kind of economic loss, given that the development would not have happened but for the use of TIF. And so this but-for test is crucial to the proper use of TIF, and statute requires that a municipality must be able to make the finding that, in its opinion, the proposed development would not reasonably be expected to occur solely through private investment within the reasonably foreseeable future, and that the increased market value of the site that could reasonably be expected to without the use of TIF would be less than the market value of the proposed development after subtracting the present value of projected increments. So in other words, the additional value created by the use of TIF must equal or exceed the value of the investment of increment. So why is this but-for finding so important? In our conceptual model, we started with the premise that the value is declining or stagnating, and then that was going to continue for the foreseeable future absent any assistance. But if instead the proposed development would occur without any TIF assistance, now the conceptual justification disappears. And when the TIF district is created, that freezing of the tax base for the duration of the district and the capturing of value to generate tax increment, that represents an economic loss, where tax base that could have supported local levies is instead providing a subsidy to development. And so this illustration highlights a worst case scenario where the proposed development would surely happen without TIF. But of course, that might not be so easy to assess. You know, it may not be so easy to figure out what would or wouldn't happen without the use of TIF. Because the but-for finding, after all, involves some subjectivity. It's unlikely to be so black and white that either no development would occur without TIF or that the proposed development would surely occur without TIF. Judgments have to be made about what would reasonably occur absent the use of TIF over a time horizon of up to 26 years. So perhaps only some modest or undesirable development could be expected late in the horizon, or perhaps a nearly comparable development would likely follow quite soon. So in between, there's all kinds of nebulous possibilities. You know, here's an illustration of perhaps a more common possibility of where, absent the use of TIF, a different development of lesser value would occur later in the TIF district's time frame. In this scenario, the start of the TIF district effectively leads to a higher value development, and the capture of value and increment is neutral until the point at which the value would have existed without TIF, and that begins to represent an offsetting economic loss that because it would have been available without the use of TIF. But in the end, there would be public benefit. It's just offset to some degree by that intervening economic loss. And these models, by the way, don't account for immediate benefits like jobs and economic activity, but they help illustrate the effects that a taxpayer may experience and the importance of making a studious assessment of the but-for finding. And note that these impacts are not just felt by the city or the TIF authority alone. While the TIF authority holds decision-making power over the use of TIF, those decisions impact all of the local taxing jurisdictions. So the county, city, school district, and special districts all see their tax bases locked into the original value and don't benefit from new value for the duration of the district. One step that is part of approving a TIF district is to give copies of the proposed TIF plans to the county and school district. But other than infrequently used options where counties, under some circumstances, can require that county road costs be included in a TIF plan, a TIF authority is not bound by any input that they provide. But giving that input its due consideration is a dutiful part of approving a TIF district. Okay, how are we doing on questions? Do we have any additional questions?
Nope, not at this moment.
All right. Well, another quiz question that we were going to ask here, just for you to give you a chance to think about it, is which of the following statements is true? A, TIF always increases tax rates. B, TIF never affects tax rates. C, TIF's impact on tax rates depend on the but-for test and timely decertification. And the correct answer is C. If the but-for test is true, the tax base wouldn't exist. So TIF isn't causing any tax rate increases, but it is kind of presumptuous to assume that the test is always perfect. I haven't gotten to this part yet, but it's also important to think about how long does a TIF district have to run. If a TIF district runs longer than is necessary, that's another situation in which there may be impacts on tax rates that aren't necessary. So, all right, well, let's get back to our definition. There's one more detail to cover regarding the identification of tax increments. Property taxes are not just a value times a rate. There's also credits that reduce gross taxes to the net tax that a taxpayer actually has to pay. Gross taxes includes both increment and regular taxes. So when a credit is applied, it proportionally reduces both the levied taxes and the tax increments. Credit reimbursements that get paid by the state then are also reimbursing both tax levies and tax increments. So you may see that a share of reimbursements is identified as a TIF credit reimbursement. Generally, the Department of Revenue reimburses jurisdictions for TIF credits, and latest data I found on their website here for 2020 only showed 11 districts and 8 counties that got paid some TIF credit reimbursements, and the amounts are, other than maybe for a disparity reduction credit, is generally quite small. So this may not be something that affects very many people because often these credits don't impact the kinds of properties that end up in TIF districts. But if you happen to see TIF credit reimbursements, be aware that those amounts are also tax increment that need to be treated as tax increment. Okay, so the last part of our definition involves using tax increment to pay qualifying costs that enable the development to occur. Qualifying costs might include things like costs for land acquisition, demolition, utilities, streets, and sidewalks. TIF is meant to be an enabling tool that helps address market failures or costs that serve as obstacles to free market activities. And that's easy to see in the case of redeveloping blight. But with housing, developers tend to focus more on market rate housing developments unless they're incentivized in some way to include affordable units. The case for economic development is subject to more debate, but the reality is that there are some sectors like manufacturing and warehousing and other industries that are competitive and footloose, meaning they can move and locate in a wide range of locations. And so subsidies are an important factor for those types of developments. And as we've seen looking at the conceptual models and the but-for test, TIF is not meant for developments that are likely to occur without the need of its assistance or for costs that aren't related to enabling those developments. And so one consideration for a TIF authority is to think about right-sizing the use of TIF or using it to the proper extent. In our example, we saw that capturing $64,000 in net tax capacity raised $87,594 a tax increment in 1 year. So for a redevelopment district that could collect increment for up to 26 years, this district might generate close to $2.3 million over the life of the district. But what if only $1 million of assistance was needed to make that development possible? This raises the important consideration of examining the extent of costs and activities that you'd want to include in a TIF plan. So without getting into all the required elements of a TIF plan, there are certain estimates that must be included. A TIF plan must include estimates of bonded indebtedness, the original net tax capacity, captured net tax capacity, and its duration. And more importantly, a TIF plan must contain separate estimates that set the total authorized cost for a district. So it must separately identify the cost of the project for things like acquisition and site improvement costs, and including administrative costs, separate estimate for interest as a financing cost, and an estimate of the increments to be generated over the life of the district. These three estimates establish the total authorized costs, or budget, if you will, for a TIF district. And the total of project costs and financing costs to be paid with tax increments cannot exceed the estimate of the amount of tax increment to be generated. So setting appropriate TIF plan estimates is an important consideration. Some might advise maximizing the estimated cost to enable the maximum expenditure of increments as a revenue source. Or is it better to minimize those expenditures to what is necessary to terminate the district as early as possible and reap the tax-based benefits as soon as possible? Another consideration is deciding whether to set an earlier duration limit than what is allowed by statute. So 26 years, for example, may be far too long to tie up a tax base if you could finance the necessary costs in 10, 12, 15 years. So another option is there's also an opportunity to share captured value. If you don't feel like you're going to need it all, you can share some of it. And then, or you could just monitor things and choose to decertify early. So let me explain this last bullet here a little bit further. An authority has a seldom used option where rather than fully capturing the new tax base, it can share some of that tax base. And so let's say from our example, $20,000 of the $64,000 in net tax capacity were shared rather than captured. That the frozen tax base is then essentially raised to include some of that new value, and it represents some immediate public benefit that would be enjoyed for the duration of the district. But the risk here is whether that diminished tax increments on the remaining retained captured value, will they be sufficient if they the estimated growth in value ends up being less than projected due to the actual scale of the development or market conditions or legislative changes that impact property taxes. So this is why most authorities choose not to share value, and a more attractive option might be to decertify the district early once the captured increment has been sufficient to cover the necessary costs. This is consistent with the 5-year rule and 6-year rules directions to identify the core in-district costs in those first 5 years, and then to decertify once sufficient increment is available to pay those costs. The idea is to limit increment capture to what is needed and to achieve early decertification and enjoy the benefits of the expanded tax base as early as possible. So early decertification is actually very common based on decertifications that occurred from 2018 to 2022. 79% of redevelopment and 77% of housing districts decertified early, and not just by a year or two, but on average by 9 or 10 years. And even economic development districts with their shorter durations decertified early 39% of the time. So early decertification has grown to be the norm, and it's been increasingly common. All right, sometimes we encounter municipalities that delay decertification and hold on to surplus increment revenues, or they want to keep the stream available for more expenditures, particularly for pooling, for out-district costs, or more administrative expenses. However, as we've seen, decertifying early maximizes the tax-based benefits, and when unused tax increments are returned to the county auditor, they actually get distributed back to the county, the city, and the school district in proportion to their tax rates. The redistributions are free of any TIF restrictions and can be used for municipal priorities. So sometimes there's this false notion expressed that, returning increment is giving it back to the state, but that's not the case. You actually get some of that sent straight back to you. So it's also wise to think broadly about the impacts on all the jurisdictions and not just on the municipality. Okay, at this point, I've largely completed the overview of the core concepts, but I do want to continue and give a brief grounding of the history and a few final thoughts. But before I do, are there any questions that have come in?
Nope, not so far.
Okay. Sorry, take a quick drink there. See, our last poll question then here was just going to be true or false. TIF districts usually last their full duration or end just a year or two early. And that, of course, is false. It's very common now for districts to decertify significantly early, and that's kind of the goal, to get to those tax-based benefits as early as possible. Okay, so a brief history will provide some good context for you. TIF originally originated nationally after World War II to address urban blight. It was meant to make redevelopment competitive with sprawling development. And the use of TIF for housing and economic development were ideas that popped up later on. The TIF concept was first actually included in Minnesota statute way back in 1947, but it was essentially ignored and inoperable until it got incorporated into the development acts that we have today. And those acts came into being during the period from 1969 to 1974. Early usage had struggled a bit with disparities between those different acts and issues surrounding how to operationalize tax increment financing. So the TIF Act was enacted in 1979 to bring order, clarity, and some basic limitations. And let's look at its timeline in Minnesota. As TIF began, there was substantial early growth. The number of cities using TIF went from 4 in 1974 to 57 by 1979, and increment went from 400,000 to 7.4 million. Counties and state legislators, though, began expressing concerns about the impacts that those districts were having, and there were some operational issues. So, like I said, in 1979, we got the TIF Act to bring that uniformity and clarity along with some basic limitations. Now, this clarity of process, however, actually resulted in massive growth. And so the concerns of counties and legislators grew with that. And so from 1988 to 1990, there were major new property limitations imposed on TIF. And although the growth continued, it did so at a more moderate pace. And TIF continued to receive scrutiny from the legislature. The 2001 tax reform had two major impacts. The class rate reductions for commercial industrial property cut captured net tax capacity by 30%. So there's a big drop in tax increment revenues. And the other thing is the state takeover of general education levies largely eliminated concerns about school aid interactions that had bothered legislators for years. And so with TIF no longer seen as driving up school aids, legislative scrutiny waned a bit, even as moderate growth continued, and changes to the TIF Act have been much less frequent since then. By 2008, the amount of tax increment being generated had peaked and began to decline as we started to see a wave of decertifications of those original large districts that were finally hitting their maximum duration limits from prior to the TIF reforms. In recent years, it looked like we were leveling out and maybe reaching a new equilibrium, but then we saw a couple of years of resumed growth before a decline in the last 2 years. So we're not exactly sure where the equilibrium is going to land, but that's what we've seen lately. And in this course, we're not going to go over all the various restrictions and limitations on TIF authority. There's more of that on Thursday. And so you don't need to digest this slide and all the bullets on it. Just wanted to offer it for some general scope and context. You can see that the TIF Act incorporated the but-for test and the need to return increments in excess of authorized costs and duration limits and limits on administrative expenses and a few other provisions. But you can see that the reforms in the 88 to 90 timeframe added a lot more. And arguably the biggest problem in the early years of the TIF Act was pooling, along with TIF plan modifications that would just expand the scope of districts so that they could spend all of the increment generated over the full duration of a district, kind of well beyond what the original proposed developments were. And to address this, pooling was limited to the 20 to 25% of increment, and the 5 and 6 year rules were added to basically limit what gets considered in district to the early stuff and to require decertification once those there's a sufficient increment to pay those obligations. In 2023, we saw significant changes amounting to the biggest changes since the NIDE reforms. Our office worked with stakeholders to discuss, some of the ambiguities and needed clarifications in the TIF Act, because that kind of ambiguity can hinder people's understanding and compliance with and our ability to provide oversight of the laws. So we made some of the changes you see listed here, and there's a separate video on these changes on our website if you want to seek that out. So given the scope of restrictions, limitations, and other legal provisions, my point here is getting some legal and professional advice is a good idea when using TIF. There are legal considerations, not just in establishing a district, but in its ongoing operation. So provisions may require actions like returning increment, decertifying early, providing notifications, addressing errors, proper reporting, remedying violations. And beyond the legal compliance issues generally, there's a significant administrative commitment to using TIF, and it's one that can last for 26 years or more. So TIF is something that requires a long-term commitment to segregate and track funds, monitor legal compliance, maintain and retain documentation, and to complete reporting obligations. So therefore, municipalities should honestly assess their own administrative capacities and take care to establish some clear duties and processes and documentation to avoid consequences that might follow from poor record keeping and improper activities. So finally, please note that one of your handouts, which we linked in the reminder email that we sent earlier today, and I think Haley's added to the chat, is a document with some resource links. And we suggest that you might want to sign up for the State Auditor's weekly updates if you haven't already. They're emailed and posted every Friday and offer tips and hints and reminders. And we also have statements of positions, training videos, articles on our website where you can access forms and instructions. And for counties, we have a TIF County Guide that is a resource. There's also links here to the Department of Revenue's Auditor Treasurer Manual, which has some good info on TIF, and to their instructions for handling some fiscal disparity TIF calculations. So with that, that concludes our presentation today. Are there any questions about what we've discussed or things that we did not cover?
I haven't seen any come in, but we can stay on the line for a minute or two. And also, I just wanted to point out that I did post the evaluation survey, so please check that out for us. And I also relinked the resource guides and handouts.
Yeah, very good. All right, well, we'll stay on here a little bit, but thank you for attending today. And again, please don't forget about that quick evaluation, and we'll stay on the line here. So have a great day, and we'll talk to many of you on Thursday.
Thanks, everybody.